Let's talk about December 10th, 2025. It was a day when the U.S. Federal Reserve made a move, a single decision that sent ripples across the entire global economy. It was a day of really high stakes, some deep disagreements, and a choice that would pretty much define the financial world heading into the new year. So, we're going to break down exactly what happened, and more importantly, why it matters to you.
Because that, right there, is the real story. You see, the Fed had to make this absolutely crucial call, but here's the catch. They were missing critical pieces of the puzzle. This wasn't just some standard, boring policy meeting. This was a massive, calculated risk, taken in a thick fog of economic uncertainty.
So what exactly went down? Well, on that Wednesday, the Federal Open Market Committee, you probably know them as the FOMC, they voted to act. They decided it was time to tweak the engine of the entire U.S. economy. And here it is. This is the number that mattered. They cut their key interest rate for the third time in a row. They trimmed it by 1/4 percentage point, what the pros call 25 basis points, and it landed right in this new range. The goal? To give a boost to a part of the economy that was looking a little shaky. But the question is, which part and at what cost?
This slide really just lays out the pickle they were in. I mean, look at this. On one side, you've got a labor market that's clearly cooling off, unemployment's creeping up to 4.4%, and if you really dig into the numbers and make some adjustments, job growth was actually negative. But, and it's a big but, on the other side, inflation was still running hot at 2.8%, which is a long, long way from their 2% target. They literally had to choose which fire to fight.
And in his own words, Fed Chair Jerome Powell made their choice crystal clear. He said the priority was the labor market. He pointed right at that slow, steady cooling as the main reason for cutting rates. They basically decided, okay, we'll tolerate higher inflation for a bit longer to make sure unemployment doesn't get any worse.
But here's where it gets really interesting. This decision was not unanimous, not by a long shot. This slide tells you everything you need to know about the deep divide inside the Fed itself. The vote was split 3 ways. You had the hawks, who were always focused on crushing inflation. They saw that 2.8% number and said absolutely not, voting to keep rates the same. Then you had the doves, who worry more about protecting jobs. Most of them voted for the cut, but there was even one super dove who thought things were so bad they needed a much bigger 50 basis point cut, a totally fractured committee.
And here's the kicker, the piece of context that makes that split vote so incredibly significant. They were having this huge debate without all the facts. An extended government shutdown had delayed all this vital economic data, things like GDP and corporate profits. So the Fed was making this massive call while, you guessed it, flying partially blind. That just adds a whole other layer of risk to what they did.
All right, so the Fed's internal debate was settled, for now. But how did the outside world react? Let's jump over to the markets and see how that first ripple played out. Well, Wall Street loved it. No surprise there. We saw a pretty big relief rally across the board, with the Dow jumping a full percent. But look closer at the Russell 2000. That's the index that tracks smaller companies. It surged 1.3%. And why is that? Well, smaller companies are often way more sensitive to borrowing costs, so the idea of cheaper money was a huge shot of confidence for them.
But here's where this really dangerous gap opened up. The market heard Powell's tone and basically thought, awesome, the party's on, more rate cuts are coming. But what the Fed actually said in their official forecast was a totally different story. That forecast, which comes from something called the dot plot, signaled that they only expected one more cut by the end of all of 2026. So you have what the market heard versus what the Fed said, and that disconnect is a huge source of potential trouble down the road.
And you know, that wasn't the only disconnect. The Fed's move didn't just cause ripples here at home. It sent waves across the entire globe, and it put the U.S. on a very different path from pretty much everyone else.
And what's so striking here is just how unusual this is. I mean, normally, all the big central banks kind of move together, more or less, because their economies are all so connected. But right now, the U.S. is hitting the accelerator, while the Eurozone and Canada are just holding steady. And look at Australia. They're actually thinking about hitting the brakes. The world's economic engines are starting to pull in completely opposite directions. And you can see the direct result of this split in the currency markets. The US dollar surged against the Japanese yen, breaking past 104 yen to the dollar. That's a level we haven't seen since the middle of 2024. This is what happens when investors sell a currency with really low interest rates, like the yen, to buy a currency with higher rates, like the dollar, all to chase better returns.
So, the bottom line is, this isn't just for Wall Street traders. This stuff matters. This divergence affects the strength of the dollar in your pocket. It impacts everything from the cost of your vacation to the price of stuff we import. It fundamentally changes where money flows around the planet, as big capital looks for the easiest path to the biggest reward. And that brings us to our final and maybe the most complex set of ripples. Because while the Fed was laser-focused on that jobs versus inflation problem, the real economy out there was sending a storm of contradictory signals that just complicates this whole picture.
First, we have a powerful sign of deflation, a massive, truly unprecedented glut of oil. 1.4 billion barrels of it was just found sitting in tankers on the water, totally unsold. This points to a huge global supply problem, and it's a major sign of weakening economic demand. It suggests the world is using less energy, and that's often the first sign of a slowdown.
But, get this, at the exact same time, silver prices surged past $60 an ounce to a new record high. This is a powerful inflationary sign, and it's being driven by booming industrial demand for things like solar panels and all our electronics. So which is it? Is the global economy slowing down, or is it booming? And the crazy answer seems to be both.
And the contradictions weren't just in the economic data. They were also political. A report came out showing that major banks were actually restricting financial services to totally legal industries they just didn't like, such as oil and gas. This shows that the flow of money isn't just being guided by the Fed's interest rates, it's also being steered by social and political pressures, which could starve critical parts of our economy of investment no matter how well they're doing.
And here's one final contradiction that really looks to the future. While all these old economy signals were totally mixed, investment in the new economy was just roaring ahead. A quantum computing firm, Quantum Art, locked down a massive $100 million funding round. This shows that a lot of investors are looking right past the current fog of data and making these huge bets on a completely different economic reality that's just over the horizon.
So, the Federal Reserve made its choice. It tipped the scales in favor of protecting jobs, of promoting growth, but as we've seen, this is all happening in a world just full of conflicting signals, global divides, and missing information. So the question we're left with is this. In trying to solve one problem, did the Fed actually create balance, or did they just swap one set of risks for a brand new one?